to dictate one of the most important questions from this topic. So write down one more very important question. Please write. Consider the following operating information. Consider the following operating information gathered from three companies. Consider the following operating information gathered from three companies that are identical except for their capital structure. So right hand side three companies, P Limited, Q Limited, R Limited. Then write down total invested capital. Total invested capital 1 lakh, 1 lakh, 1 lakh. Total invested capital 1 lakh, 1 lakh, 1 lakh. Then write as debt to asset ratio. Debt to asset ratio. Debt to asset ratio is 0.80, 0.50, 0.20. Debt to asset ratio 0.80, 0.50, 0.20. Share outstanding. Share outstanding. $6,100, 8,300, 10,000. Then write before tax cost of debt. Underline the word before tax. Cost of debt 16%, 13%, 15%. Cost of equity 26%, 22%, 20%. Cost of equity 26%, 22%, 20%. Then operating income EBIT in rupees 25,000, 25,000, 25,000. All three companies are same. Net income 8970, 12,350, 14,950. That is your profit after tax. Net income means final profit figure. And then tax rate 35%, 35%, 35%. The question is compute WACC for each firm. Compute WACC for each firm. Point B, compute EVA for each firm. Compute EVA for each firm. Compute EVA for each firm. Point C, based on the results of your computation in part B, based on the results of your computations in part B, comma, which firm would be considered best investment? Which firm would be considered best investment and why? Which firm would be considered best investment? Question mark. Why? Question mark. Point number D. Assume the industry P ratio. Assume the industry P ratio generally is 11x. Assume the industry P ratio is generally 11x. Using the industry norm, estimate price for each share. Estimate the price for each share. Calculate the expected market capitalization of each firm. calculate the expected market capitalization of each firm. One more question, E. Question number E, what factors would cause you to adjust P ratio value? What factors would cause you to adjust P ratio value used in part D so that it is more appropriate? What factors would cause you to adjust P ratio value used in part D so that it is more appropriate? So this is a lengthy problem. First question is WACC, second is EVA, third is which firm will be selected for investment. They are similar firms, capital structure is different. If you see point number 2, debt to asset ratio, P Limited is having more debt, R has least debt. So capital structure wise, P is more leveraged firm, R is least leveraged firm, and because of the difference in their debt equity ratio, even though their operating income is the same, but their profit after tax is different because interest amount will be different, and because of that the final profit after tax is different. Then next question is, assume that the industry P ratio is 11. P ratio is price earning ratio. So since the net income is given, number of shares are given, I can calculate EPS. EPS multiplied by P ratio of 11 times will get market price. Market price into number of share will give you market capitalization. So that's very easy. And the last question is, what factors would you consider? What factor would cause you to adjust P ratio value based in part D, and so that it is more appropriate? So that's a theory question. You are using same P ratio for all the three companies. Is it an appropriate approach? If not, then why would you take different P ratio for different companies? So that small note on use of same P ratio for different companies which have different capital structure is not appropriate. That note you have to write. That will come later. So the new question they have added here is the last two questions, D and E. So they have merged the chapter of valuation using P multiple with the economic value added chapter. First question was, calculate WACC of each firm. So that is really easy. Start. Calculation of WACC of each firm. Right hand side 3 columns. First point A, weight of debt. Weight of debt WD 0.8, 0.5, 0.2. Weight of debt in bracket WD. Then write weight of equity. Weight of equity in bracket WE. So that will be balancing figure. If the weight of debt is 0.8, 0.5, 0.2, out of the 100 rupees asset, 80% is debt. So 20% will be equity, 0.2, 0.5, 0.8. Debt to asset ratio is given. Now write down post-tax cost of debt. Post-tax cost of debt. You are given pre-tax cost of debt. Post-tax cost of debt, write down KD is equal to I into 1 minus T. I into 1 minus T. Take the interest rate given in the question and multiply by What is the tax rate? 35%. So you directly multiply by 65%. You will get 10.4%. Q Limited, take the pre-tax debt interest rate into 65%, 8.45. Similarly, R Limited, interest rate into 0.65, 9.75%. Good news, cost of equity is given. Copy 26%, 22%, 20%. Cost of equity is given. Now you will write WACC. WACC equal to WD into KD plus WE into KE. WD into KD plus WE into KE. So take your calculator and do it. 0.8 into 10.4 plus 0.2 into 26. This way you have to do. So you will get 13.52%, 15.23%, and the last one check 17.95%. Presentation can be changed, but the answer must be the same. So this is your first answer, 2 marks for this much effort. Second question is very easy. It asks you to calculate EVA. Invested capital is given to you. WACC we have computed. Okay. EBIT is given to you. From EBIT, I will directly get NOPAT by deducting taxation. So write down 3 columns on the right side. Heading is calculation of EVA. P Limited, Q Limited, R Limited. Point number A, NOPAT. NOPAT in bracket EBIT. 1 minus 0.35. Take the NOPAT, take the EBIT, which is 25,000, into 0.65, 16,250. It will be same for all the 3 companies because their EBITs are same, tax rate is same. Point B, invested capital, same for all the 3 firms. All the 3 firms are similar. Internally, their debt equity ratio is different. Total amount of capital invested is 1 lakh. WACC, step number 1. WACC, step number 1. 13.52%, 15.23%, 17.95%. Point number D, capital charge. B into C, write down. Capital charge B into C. Multiply without calculator. I will tell you 13520, 15230, 17950, and then last point E, EVA, A minus D. A minus D, first line, fourth line. Take the difference. The answer is 2730, 1020, negative 1700, negative 1700. Now which company you will invest in? So the answer is the company which will have higher EVA. In that company we are going to invest. So write down the note. If the EVA is the deciding criteria, then the answer will be company with higher EVA. P Limited. P Limited is the best investment as it has the highest EVA. As it has the highest EVA. Next is the reason for higher EVA is. The reason for higher EVA is why it has got higher EVA than other firms when they have invested same capital, when they have same EBIT, is because of the high debt equity ratio. And because of the high debt equity ratio, the overall cost of capital goes down because debt is much cheaper than equity. So average cost of capital, can you see here on point number C, is very low compared to the other two firms, and that makes your capital charge lower, and if capital charge is lower, your answer is bound to be higher, final answer will bound to be higher. So write down the reason also. The reason for higher EVA is the high debt equity ratio of P Limited, which has resulted in lower WACC, If only up to EVA they ask you for 4 or 5 marks, then your answer will end here. But there are some extra questions they have added where they want you to compute the price, the market capitalization, and then comment on the use of P ratio. So write down step 3. Step 3 will be calculation of price of each firm and market capitalization. Under that write down 3 columns P, Q, R. First point A, net income 8970, it's given in the problem. If you see the problem last few lines, it is there, copy from there, 8970, 12350, 14950. Number of shares, this is also given in the question. Search for number of shares. If P ratio is given, the formula to get the price is EPS into P ratio. So we need to reach EPS, number of shares. Therefore EPS A by B on your calculator, 8970 divided by 6100, 1.47. 12350 divided by 8300, 1.49. 14950 divided by 10,000, 1.50 approximately. P ratio given in the question, second question, 11x is written. So that is 11 for all the 3 firms. Price write down C into D. Multiply 16.17, then 16.39, 16.50. This is price per share. And now we'll write market capitalization, B into E. So take the number of share from point number B multiplied by price from point number E. That will give you market capitalization. So that comes to 98637. Check the next one, 136037, 136037 and 1,65,000 and 1,65,000. Should we use the same P ratio for all the 3 firms? Is it appropriate to use the same P ratio for all the 3 firms? So the answer is no, because P is riskier. It has a higher debt equity ratio. So it will have a lower P ratio, whereas R Limited is least risky. So it should have been assigned a higher P ratio. Investor will favor R Limited from risk point of view because its debt equity ratio is very low compared to P. So therefore using same P ratio for company with different degree of financial risk is not appropriate. One should adjust P ratio according to the risk involved also. So the one note I have to write for the 5th question. Please write note, conceptually, it is incorrect to use same P ratio for valuing firms. It is incorrect to use same P ratio for valuing firms with different levels of risk. With different levels of risk. One can adjust P ratio. One can adjust P ratio to recognize different levels of financial risk. One can adjust P ratio to recognize different levels of financial risk. This answer is over.